Welcome to the deep dive. We're ripping apart a record financial beat today, Morgan Stanley. Just wow, shock Wall Street with their Q3 earnings.
Yeah, absolutely. Our mission here is to unpack those surprise numbers and maybe more importantly, dig into the strategy, the guidance, this whole capital markets flywheel idea. It seems like it's really spinning now.
Okay, let's get straight into it then. The headlines were, well, huge. Record net revenues, $18.2 billion. That's up 18% year over year.
And already beating forecasts by what, over 9%? That alone is pretty strong.
But the real story, the shockwave, that was the bottom line, wasn't it?
Yeah.
Diluted earnings per share, EPS, $2.80.
Right. And remember, analysts were expecting something like $2 or 9, maybe $2.10, beating that by nearly 34%. That's massive.
34% beat on EPS, and net income surged 45% year over year to $4.6 billion.
It really makes you wonder.
Yeah, I was going to ask, if the forecast was off by almost 80 cents a share, I mean, were analysts just completely missing something? Or, was this padded by some one-off thing we should be wary of?
That's a fair question. But looking at the breakdown, the sources suggest it was pretty broad-based growth, not just, say, selling off a big asset. It feels more like the market just underestimated how fast things could rebound in their institutional businesses and how much that integrated model could deliver.
And the market reaction definitely showed that confidence. The stock jumped, what, almost 6% in pre-market?
5.89%, yeah. Investors clearly liked what they saw, and that speaks volumes.
Okay, and efficiency-wise, that return on tangible common equity, the ROTCE number, that jumped too.
No, significantly.
Yeah.
From 17.5% last year up to 23.5%. That's a really eye-watering number for ROTCE.
23.5%.
Yeah, and that really backs up what the CEO, Ted Pick, was saying. Quote, "Our integrated firm delivered an outstanding quarter." He stressed the performance across all the businesses. It wasn't just high revenue. It was about that strategy, that flywheel, actually generating better operational results, more efficient profits.
So the different parts are really feeding each other now.
Exactly. And to see how, we probably need to break down those three main business segments.
Right. Let's start with institutional securities, ISG, that's the investment banking, the trading side. And it looks like the capital markets rebound is definitely here.
For sure. Investment banking revenue itself surged 44% year over year. That's $2.11 billion, a really strong quarter for IB recently.
44%. What drove that specifically?
It was across the board, really reinforcing that flywheel idea. Advisory, so M&A, was up because more deals actually closed.
Yeah.
Equity underwriting was strong.
IPOs coming back?
Yes, IPOs, convertible offerings.
Okay.
It signals a much healthier market for companies wanting to raise capital. And fixed income underwriting grew too, both investment grade and non-investment grade loans.
So deal making is heating up again. But how does, say, an IPO directly fuel the other parts of Morgan Stanley, that integrated model idea?
Well, think about it. An IPO happens. ISG makes fees, obviously. But that IPO also creates potentially thousands of new shareholders, the employees of that company. Those employees with their new stock holdings become prime candidates for
wealth management, the other big pillar.
Exactly. The deal flow directly creates the potential client assets that feed the other side of the house. That's the flywheel in action.
Got it. Okay, and trading. The floors must have been busy too.
Absolute booming. Equity trading revenue jumped 45%. That's $4.12 billion. They mentioned strong client activity generally, but specifically called out record results in prime brokerage.
Servicing the hedge funds, so big players are active.
Very active, high confidence, high trading velocity, and even fixed income, which can be more volatile, was solid, up 8% to $2.17 billion. Mostly credit and commodities driving that.
So ISG overall, a huge contributor, $8.5 billion in revenue for the quarter, a massive swing back.
A huge swing. But, ISG is cyclical by nature. Markets go up, markets go down. That's why the other engine is so crucial.
Right, the counterbalance, wealth management or WM, the steady, durable part of the business.
Exactly. It's the anchor. WM delivered record net revenues too, $8.2 billion, up 13% year over year. Consistent growth.
And the profitability there is pretty amazing. Pre-tax margin at 30.3%.
Almost like clockwork. But the number that really points to the future, I think, is the net new assets, NNA.
How much did they bring in?
$81 billion.
Yeah.
In one quarter.
$81 billion. Just,
Yeah.
wow. That brings the total client assets across wealth and investment management to what now?
$8.9 trillion? That's up $1.3 trillion just in the last year. The scale is incredible.
So where are these new assets, this $81 billion, coming from? Is it just market appreciation or?
Well, the CFO, Sharon, she actually highlighted how they're capturing it. A lot of it comes through what they call the workplace channel. This is really where that flywheel mechanism shines.
Okay, explain the workplace channel connection. How does an IPO turn into a sticky wealth client?
So when the firm handles an IPO, they often manage the employee stock plans for that company. That's the workplace channel. Initially, those employees might just have shares sitting in a basic self-directed account. But the key insight the CFO shared was that assets are actively migrating
Migrating how?
from those basic accounts into the higher value advisor-led relationships. They're converting that initial transactional contact from the IPO into a full-blown long-term wealth management client, ideally with a dedicated advisor.
So the investment bank seeds the ground and wealth management harvests it. That integration sounds like a serious competitive advantage.
It really is. And they're not just waiting for deals, they're investing heavily to keep winning those clients. They mentioned expanding their work with Carta for private market assets.
Right, tracking employee stock in private companies.
And also new partnerships, like with Zero Hash for digital assets, making sure they're relevant for where wealth is being created next.
Okay, brings us to the outlook. Is this Q3 surge sustainable? Or just a good quarter in a bumpy market? What's the forward guidance telling us?
Well, CEO Ted Pick sounded pretty bullish, especially on investment banking long term. He expects that whole category, quote, should be generally up and to the right over the next couple of years.
Why so optimistic?
Two main reasons he cited. One, just the sheer volume of deals that have been kind of stuck in the pipeline because of rate uncertainty, pent-up supply.
Yeah.
And two, something really interesting, the need for companies to finance the massive costs of integrating AI.
AI development and deployment costs.
Yeah.
Needing underwriting. That's a smart angle. Flows right back to ISG.
Exactly. And thinking about sustainability, that brings us back to the wealth management margin, that 30.3%.
Yeah, is that the new target? Can they keep it that high?
Ted Pick actually addressed that. He said the 30.3% is an output, not necessarily a target they manage to rigidly. The priority, he emphasized, is input. Investing in the business E-Trade Pro, that workplace channel, technology to drive overall profit before tax, the PBT growth, even if the margin dips slightly below 30% sometimes because of those investments.
Input over output. Focus on growth investment. Makes sense.
And they can afford to make those investments because their balance sheet is, well, rock solid.
Let's talk capital then. Their standardized CET1 ratio.
Strong, 15.2%. And they got a nice little tailwind recently when the Fed lowered their stress capital buffer, the SCB.
Right, that went down from 5.1% to 4.3%. What does that practically mean?
Well, for you listening, the SCB is basically extra padding of the Fed, makes banks hold for tough times. Lowering it frees up capital. It means potentially hundreds of millions more they can use for lending, maybe acquisitions, or just returning more to shareholders. It increases flexibility.
And they definitely have flexibility. They mentioned having over 300 basis points, that's 3%, of excess CET1 capital above the minimums.
Which allows them to do things like buy back stock. They repurchased $1.1 billion of their shares just this quarter.
Okay, so strong capital, investing for growth. Where are those investment dollars going? You mentioned AI earlier.
Yeah, AI seems central to the future growth story, especially for knitting the firm closer together. The CFO detailed 3 specific examples.
I think I saw those. DevGen AI for developers, Parable for summarizing data quickly.
Seem like internal efficiency tools.
They are, partly.
Right.
But the third one, Lead IQ, that's where the strategy really clicks.
Lead IQ, what does that do?
It's an AI platform specifically designed to connect financial advisors with those clients coming from the workplace channel.
So that's the automated link. IPO happens, employee gets stock.
Lead IQ identifies them as a prospect, figures out their needs based on the data, and matches them with the right kind of advisor within Morgan Stanley. Automatically. It's designed to make sure those assets, that opportunity created by ISG, doesn't walk out the door. It maximizes the cross-sell, using AI to accelerate the flywheel.
That's pretty slick, really embedding the integration with tech.
Exactly. And the CFO basically said, quote, "We're just scratching the surface of what AI can do. They clearly see a lot more potential there."
So recapping, EPS beat by nearly 34% to $2.80, driven by a huge ISG rebound, but also that steady, massive scale of wealth management, a true monster quarter, built squarely on that integrated model finally hitting its stride, accelerated by technology.
And looking ahead.
Well, firm's been pretty clear. The next big target is $10 trillion in total client assets. They're at $8.9 trillion now. So the thought to leave you with is, what kind of organic growth, what kind of speed, maybe even inorganic moves will it take to close that $1.1 trillion gap? How fast they get to and blow past $10 trillion. That'll really tell us the true velocity of this capital markets flywheel they've built.